Welcome to Smart Trading Action Alert. I'm Laura Cadden. The news in real estate keeps getting uglier. Just last week, we learned that older home sales set a record in March, but not the kind of record anyone brags about. They dropped by the largest amount in 18 years. Most would argue that an 8.4% drop in the sale of older homes could partly be the result of March's winter weather and, of course, the collapse of the subprime lending sector. So what can we expect for the future of American real estate? Will the annual addition of 3 million new Americans by birth or immigration manage to keep both population growth and housing demand sustainable at somewhat reduced levels? Or are we dealing with a long-term shift in money flow that will depress real estate and the building industry for years to come? More importantly, are there ways to play both the upside and the remaining downside with profitable trades and investments? My guest today is Adam Lass, who built his reputation on the development of his wave strength predictive systems. So Adam, I know that housing has long been of interest to you and you monitor various sectors for your broader market analysis. Where do you see it heading next?
Well, I'll tell you, this has been an astounding time for housing. I mean, even the bears were blown away when the latest reports came in 3 times worse than they thought they would be. This has been possibly one of the most gloriously punished sectors in American stock world in ages. And I think it actually makes the sector in some ways more interesting right about now.
So you're saying, despite all that's wrong right now with real estate, we should be buying this sector?
Well, in fact, almost for all the reasons that are something wrong with real estate, or to put another fold in it, there's so much wrong with real estate right now, and yet we're starting to see the people out there get a renewed interest in real estate despite all this, and that's an interesting fold. That's an opportunity.
So when the stock market crashed back in 2001, it seemed like a lot of new money was seeking safer investment and higher gains, and they turned to real estate for that. In fact, it could be said that much of the capital that funded the stock boom of the 1990s diverted to real estate in like April of 2001, September. With the current bust in real estate, how do you see it correlating to the Dow at 13,000?
That's been one of the more interesting parts of the story. The problem with real estate as an investment is that there's no central clearinghouse in the same fashion that stocks have. When people wanted to move from the stock market to real estate, all they had to do was be willing to stomach a sizable loss. It was up to them whether they sold on today or tomorrow, and at the push of a button, they were out of the stock market and they could begin looking with what liquid cash they had for a new investment. Housing isn't like that at all. Housing is a huge hassle to get in and a huger hassle to get out. I mean, just buying houses, anyone knows, is 1 million meetings, 1,000 forms, and bankers and lawyers and deeds and the whole, it's an incredible hassle. Getting out is the same story. There's no button you can push to get out of a house. There's no central clearinghouse. You wish to sell, you put the house on the market. There's 1 million people who have an idea as to how much you should sell for, and it's so contingent on so many things. It's really slowed down the ability of people to move from housing into the stock market. But we're starting to see that period end. We're starting to see some cash get liberated, and lo and behold, the moment that cash got free, we see a swell in the stock market as people resume what is in essence a sector rotation from one asset to another.
Just this morning, I wanted to ask you about this. I passed a new town home community that was being built, and they were advertising a fixed rate of 5.25%. Now this is well below market rates. One could argue that the market itself will take care of the overbuilding and excess, condominiums everywhere from past years. How do you see demographics influencing housing demand and prices after 2007?
Well, the thing to remember with housing is that it's never going to die. People have to live somewhere, and there is a new cadre of people moving in who do need housing. We will see always, to a certain extent, a constant demand. What's gone from the market for a while now is the speculative market, the flippers who were in it not to own the house, but just as a disposable asset, who found that it's not such a disposable asset after all. But now we start to see an interesting change come in. We start to see signs of a bottom forming up on the charts. We start to see some interesting corollary indicators. On my charts, they would be things like looking at particular ETFs. We start to see a bottom move on the charts. We start to see momentum pick back up. We start to see moving average, convergence, divergence, MACD, always a good indicator, start to cross over and show that Just as this starts to bottom out, people are regaining an interest. And part of that is because they were talking a year ago about an 18-month inventory overage in housing. Now, any other business in the world, when it has an overage, it discounts. It hurts for a while to be the guy that has to sell at a discount, but you burn off excess inventory through discounts. And that's exactly what you saw the other day. The big owners of new homes are discounting their overage of inventory, but they've been doing it for a while now. And where we were talking 18 months of excess inventory, now we've whittled that down to a much more manageable number. Now we're looking at somewhere between 6 and 9 months of excess inventory. And if you're a forward-looking business like the stock market is, home building stocks might actually begin to look attractive again. We're seeing a groundswell of early adopters starting to go, maybe I'll take a step in. But you have to be careful how you do it.
Speaking of the market, of course, on smart trading, we like to focus on shorter, medium kind of term profit potential. So how would traders choose to capitalize on these signs? I'm assuming not by buying condominiums, waterfront condominiums in Florida.
No, the last thing you want to do is get locked into real estate again. That's the mistake that so many people found, is that if you're owning something with an address, then you've got all the hassles associated with getting in and getting out. But if you get involved in one of the ETFs that bundle, I mean, first of all, you could always buy an actual real estate stock, but better yet, if you get involved in an ETF that bundles several real estate stocks together, now you've got a much more liquid asset that when the time comes, again, should you wish to, unlike a house, you can actually push a button and get out of. And then again, let's add another fold on top of that. If it's motion we're looking for, then you might not choose to own even shares. My suggestion actually would be to own options against that move, much cheaper in the long run. An example, Cohen and Steers, iShares Cohen and Steers, it's ICF is its ticker. If you were to get involved in, say, August 102 calls, they're roughly at the money right now. They're going for roughly $5, $5.50. I'm looking for a $5 to $10 move on that particular ETF over the next few months. A $10 move on that ETF would double the value of that option with certainly much less commitment cash-wise than buying shares would be to get the same bang for your buck, and a fraction of the hassle and commitment buying real estate with addresses would do for you.
Interesting perspective. Thank you for the information.
Always my pleasure.
To learn more about investing ideas like this, go to www.wavestrength.com. Please tune in next week for another profitable opportunity on TFN's Smart Trading Action Alert. For TaipanFinancialNews.com, I'm Laura Cadden.